Tell us what this day is all about, what the action means to you.
You know, I tell you this, I think it's good that we're kind of faded into the afternoon, only because the incremental news we got wasn't new. It's not great. What we did do is avoid worst case scenario. So avoiding worst case scenario would be escalation, coming back from the G20.
More tariffs.
More tariffs, exactly. And that's going to have an immediate economic impact. Now we know where we stand. We know what the bid and ask is. Someone has to compromise on either side of this, and that probably takes a while. So we're at or about where we should be. I think we do. I think we do very well to spend most of July kind of sideways and rationalizing the gains that we have.
So then, is it safe to say that all of the ongoing continued uncertainty around trade is kind of priced into the market here?
To a certain extent, yeah. What we know. What's not priced in is the length, the duration. How long does this take? Because the longer it takes to get this behind us, the more economic damage is done. So, unfortunately, coming into May, we thought we were almost done. And we saw exactly what happened. We found out that that's going to be much longer. We can have another one of those events if something triggers another one of those escalations. So that's where we are right now. We're at or about where we should be, unless things get worse.
Lindsey, what do you think? You agree?
What I would say is I think that the market actually, and it was what you saw in today's action, was pricing in a deal getting done, the hope of a deal getting done in the near future. Because to your point, if this does extend into the end of the year, we're going to have major economic implications. You're already seeing a slowdown in Asia. We saw some of those PMI numbers out of Europe, Germany especially, seeing major weakness. So I think that you're starting to see this bleed into economies around the world, and then it's only a matter of time before it gets to the U.S. because about 44% of U.S. sales for the S&P 500 come from abroad.
All right, so Art, does that mean that the chances of the Fed cutting rates this month have just increased?
I would say in the Fed's mind, they probably have increased. In the market's mind, they probably decreased. The market's way ahead of themselves. They think it's a 100% chance in July. I think the Fed is at a point where the longer this lasts, the more they're going to have to step in. I don't think it's July, but they're certainly going to cut this year.
You know what? The Fed does not want to upset the market, though, in any great magnitude. If it didn't go at all in July, the market wouldn't take that well, would it?
Well, it depends what we get in between now and then. So we've gotten G20 behind us, and there was no disasters. We'll get a first print of the second quarter GDP, and we get another jobs number. I think those will be very telling. If both of those are better than expectations, then I think the Fed can sit back and say, we're very close, but it's just not time yet.
Lindsey, how much more focus does this put on the jobs report on Friday?
Yeah, it's going to be a huge, huge focus for the market for sure because, you know, we're seeing some pockets of weakness in manufacturing and housing. Of course, we've been seeing that for quite some time now. But because May was so weak, we need June to be better.
You got to get the market out of its, if you want to call it a defensive posture, too, right? The environment where, bond proxies, things like staples, bonds themselves are going up, gold. You're going to have a hard time rallying more broadly if all of those more defensive spaces continue to do well, right?
Very true. I think what's going to be interesting, and we hit this at the top of the segment, financials. The dividends on financials, now that they were able to increase them and they passed their tests and they're buying back their shares, should be very interesting. Because when you think about the multiple that utilities and staples are trading at and how low the yields are, I think you make a very good point. I think it's important for something to take over leadership, and maybe financials step in here, at least in that search for yield.
Yeah, financials have been weak, so has healthcare, and I think we'd like to see healthcare really pick up some steam, especially because it's the second largest sector within the S&P 500.
The Fed's going to cut rates. You could get a steepening curve, which, to your point, is another catalyst for the financials, which they just haven't had one.
They haven't had one, except
for...
Whole
focus has been on rates.
A lot of M&A activities, great calendar for IPOs and secondaries, so that action has been very good. Trading has been pretty robust. It's just that net interest margin they haven't had.
Exactly. Arthur, thank you.
Thank you.
Good seeing you.